The world's most important oil route goes silent. Tankers stop, markets panic, prices surge. Within hours, fuel costs rise, stock markets fall, and global trade begins to freeze. This is not a movie trailer. This is a real-world scenario unfolding at the moment. Right now, rising tensions between the United States and Iran are putting one of the world's most important trade routes at risk, the Strait of Hormuz. This is not just a political conflict, this is a global economic threat. In this video, we'll explain the current US and Iran situation, why the Strait of Hormuz matters so much, and how a possible conflict could affect oil prices, global trade, inflation, and everyday life across the world. In early 2026, global markets are once again on edge as tensions between the United States and Iran intensify. Military alerts, sanctions, diplomatic warnings, and naval movements in the Middle East have revived fears of a wider conflict. While there is no official declaration of war, experts agree that the situation is extremely sensitive. A single incident could escalate tensions rapidly. But beyond military headlines, the real story lies in economics and global trade. History shows that even the threat of war in the Middle East can disrupt oil markets, raise inflation, and slow global economic growth. At the center of this risk is one strategic choke point that connects the Middle East to the global economy. As of now, the United States and Iran are not officially at war, but relations are highly strained. The US maintains economic sanctions on Iran and has increased military preparedness in the region. Iran, on the other hand, has warned that it will respond forcefully to any direct military action. Diplomatic efforts are ongoing through regional and international mediators, but trust between both sides remains very low. Military analysts describe the situation as a high-risk standoff. For global markets, this level of uncertainty is enough to trigger volatility, especially in energy and trade-related sectors. The Strait of Hormuz is one of the most important waterways in the world. It connects the Persian Gulf with the Arabian Sea and the Indian Ocean. Despite being narrow, it carries an enormous volume of global energy supplies. Around 20% of the world's traded oil passes through the Strait of Hormuz every single day. Major oil-exporting countries rely on this route, including Saudi Arabia, Iraq, the United Arab Emirates, Kuwait, and Iran itself. There is no alternative route capable of handling this volume of oil quickly. This makes the Strait of Hormuz one of the most critical choke points in global trade. Any disruption here, even temporary, can send shockwaves through global markets. Oil prices react instantly to geopolitical risk. Even without an actual war, the fear of disruption can push prices higher. Traders add a risk premium when they believe supply could be threatened. If tensions escalate further, oil prices could rise sharply due to concerns over reduced supply and shipping delays. Higher oil prices affect nearly every sector of the economy. Fuel becomes more expensive, transportation costs rise. Manufacturing costs increase, food prices go up due to higher logistics expenses. In simple terms, higher oil prices mean higher inflation worldwide. A conflict in or near the Strait of Hormuz would significantly affect global shipping. Oil tankers and cargo ships would face higher insurance premiums due to increased risk. Some shipping companies might reroute vessels who avoid danger, leading to longer travel times and higher fuel consumption. These additional costs are passed on to importers, exporters, and eventually consumers. Higher shipping costs directly affect global trade efficiency and profitability. Modern supply chains are deeply interconnected. A rise in energy and shipping costs disrupts industries across the globe. Sectors most affected include electronics, automobiles, agriculture, pharmaceuticals, and consumer goods. Countries that depend heavily on imported energy are especially vulnerable. Production costs rise, competitiveness declines, and inflation pressures increase. One of the most serious global consequences of the US and Iran conflict would be rising inflation. Here's how it happens. Oil prices rise due to supply fears. Transport and logistics become more expensive. Businesses pass these costs on to consumers. As a result, everyday goods like food, clothing, and household items become more expensive. Higher inflation reduces purchasing power and puts pressure on households, especially in developing economies. Central banks may respond by keeping interest rates high, which slows economic growth and investment. Countries like China, India, Japan, and South Korea rely heavily on oil imports. Higher energy costs increase production expenses and reduce export competitiveness. Inflationary pressure can weaken currencies and strain government budgets. European economies already face energy security concerns. Any disruption in oil supply could worsen inflation and slow economic recovery. Developing countries are often hit hardest. Weak currencies, higher import bills, and rising inflation can create economic instability and social pressure. Financial markets react strongly to geopolitical uncertainty. In times of tension, investors often move money away from risky assets towards safer options like gold and government bonds. Stock markets become volatile, and emerging markets may experience capital outflows. Even rumors of escalation can trigger sharp market movements, affecting retirement savings, investments, and business confidence. Diplomatic talks succeed, tensions ease, and markets stabilize. Oil prices gradually normalize, and global trade resumes smoothly. A short-term military incident causes oil prices and shipping costs to spike temporarily. Markets remain volatile, but adapt over time. A prolonged conflict severely disrupts oil flows and trade routes. Inflation rises globally, economic growth slows, and global trade suffers. Experts believe a total closure of the Strait of Hormuz is unlikely, but even partial destruction would have serious global consequences. This conflict is not just about politics or distant wars. It affects fuel prices, you pay prices of everyday goods, job markets, and business costs, investments, and savings. Understanding the connection between geopolitics and global trade helps you make better financial and economic decisions. The rising tensions between the United States and Iran highlight how fragile the global economy really is. The Strait of Hormuz is not just a waterway, it is a pressure point for global trade, energy security, and economic stability. Even the possibility of conflict is enough to shake markets, raise prices, and disrupt trade flows. As the world watches the US and Iran situation closely, one thing is clear: when geopolitics moves, the global economy moves with it. If you found this explanation useful, like the video and subscribe for more insights on global economics and geopolitics.